Mr. Sanjay Banka, the CFO at Senco Gold, joins us now. Mr. Banka, hi, good to be speaking with you. Anisha this side. Just wanted to put the spotlight on the quarter gone by because we didn't discuss your earnings since then. The
Yeah.
SSSG came in at around 4% in Q1, and that compares with the double-digit growth that we had seen in the earlier quarters. What led to a bit of a slowdown, and is this slowdown likely to continue in Q2 as well with respect to the volume growth, the SSSG growth in Q2?
No, this quarter one, the growth was 9% overall. 11% growth we had in retail, and SSG was 4%. Now, basically, the quarter one was impacted by, as you've said earlier, by heat wave, by elections, and by rising gold price. So these multiple factors created an impact, and not only Senco, but the entire industry, barring a few players. So we are quite confident, and we have said it that no, we will continue to grow at 18 to 20% in future, and even the current trend. So the trend which was for quarter one, and as we speak today, the trend is again in the same trajectory. Almost 18-19% growth is happening, which means that in last 40-50 days, the growth is more than 20%, so that the cumulative growth is around 19%. And with the movement in the gold prices, so with the custom duty fall by almost 9%, there was renewed confidence in the customer. The buying started, and we are sure that moving forward, the consumer knows that the gold price short-term movement, even though it is created by the custom duty fall, in the long term, gold will continue to be a safe asset, and due to that, we will continue to grow at 19 to 20%.
But Mr. Banka, the Q2 trends that have panned out in the last 1.5, 2 months, what would you say the Q2 growth is likely to be like? Is it still going to be 4-5% SSSG, or it could be low double digit or high single digit? Any initial indications?
It will be low double digit. So I think the SSG will be consistent. We have said a broad formula we had given that of the total growth, 70% will come from SSG. So if it is 20% round, 13 to 14% SSG will be there. That was the past trend for a few years, and even last year. And YTD, we are seeing the same trend. So we are quite confident that the majority of growth will come from SSG, because they will give a full-blown impact and the result as they start maturing.
What is the studded jewelry ratio as of now? Because we understand it's just about touching the 10% mark. Given what the gold prices are up to right now and continue to be at an all-time peak, where do you see this figure moving?
So there are multiple trends and targets which have been given. So first target was 2,500, which has been bridged now. So this 2,500 we have been talking for last 3 to 4 months, and with the increase in the rate to 2,500, we are almost at around 71,260 today. The fresh resistance which are being given is around 2,600 by September and 2,700 by March 25. So that means another $200 rise is expected. $100 in 3 months, and another $100 by March 25. Moreover, the rupee dollar rate which RBI is holding, that is also it is expected that it will depreciate further, which will lead to increase in the gold price.
How much
So
of your
we can safely look at 76,000 rate in the near future.
how much of your current business is coming from the regional, regional pockets, which is like the traditional pocket where you have a stronghold in and around Bengal, and how much is coming from new geographies?
So we have seen a secular growth trend across India. So it's not only in East region, and East region is not only Bengal. East region is Bengal, Bihar, Jharkhand, Odisha, Assam, Tripura, Sikkim. Quite a large part where the consumption is growing and the growth is picking up, and it's a gateway to the east. So the growth is consistent. And in terms of percentage revenue contribution, we have seen around 70 to 75% is contributed by East and balanced by rest of India. And last year, our out of our total top line of around 5,200 crore, 700 to 800 crore was from outside East. So we are quite confident that we will continue to maintain the leadership in the East with our 85 years plus legacy and customer centricity. And rest of India, we are consistently growing.
You are, let's say, moving into Delhi, North India. That's not your main area of focus. That's where old traditional Delhi-based jewelers are already present, and that's where, let's say, brands like Kalyan or, for that matter, Tanishq, they're already present. Why are you entering into markets where the competitive intensity is high?
We have already entered Delhi. Delhi, we are there for more than I think 10 years. The Lajpat Nagar. So as of now, we have around 21 to 22 store in Delhi NCR, around 10 stores in UP, and another 10 12 stores in Delhi. We have got four stores in Gurgaon. In Delhi, we are now present across Delhi. We are present in almost all the areas. In South Ex, we are in Noida. We are in Rajouri Garden, we are present. So it's a very good market for us, and you'd be very happy to know that our stud ratio, which is on an average of our own and franchisee taken together, was around 11%. In Delhi NCR, it is 17%. So the consumers of Delhi clearly prefer Senco as a brand of choice. And moreover, our competition is not with the listed players which you have referred to. Our growth will be clearly driven by movement from unorganized to organized, and all of us will have a place to make. So while we are aware about competitive intensity, but the unique value proposition which we offer in terms of lightweight jewelry, in terms of Bengal Karigari, in terms of large design which we introduce. So you will always find something special in Senco which you will not find at any other jeweler.
Fair point. So what, to your mind, is the benchmark to understand margins? Since you are listed now, markets would use, let's say, Titan or Tanishq margins as a benchmark. Then there is Kalyan Jewelers. So if I compare them both on absolute basis and a relative basis, your absolute growth, sir, is great. You're expanding, and on your base, it's very expensive, or it's very impressive. But if I look at the absolute margin comparison, you are still a distance away from the market leader. Why is that?
So first of all, the largest player, Tanishq, which you are saying, their stud ratio is more than 27-28%. So that is a very important contributor in the overall margin. Then the diamond price itself charged by our listed players are quite higher. We offer a very competitive price as far as our diamond is concerned, because we want to make it affordable. We don't want to make diamond as a luxury brand, a luxury product. We want to make diamond to reach to each and every household. So we have kept the prices low in order to penetrate the market. Uh, but our overall margin, gross margin, I'm saying, and then I will come to EBITDA. Our overall gross margin, which was around 15.5% last year, it's a blend of the margin from the own store and franchisee. But if you look at our gross margin from own store, that is around 19 to 20%, which is second highest in the industry. 19 to 20% gross margin from own store is either second highest or third highest. It's only when we make it blended with a franchisee margin and own margin, it looks to you around 15.5%, which you have seen around 17% in Q1. So we have said that our blended gross margin from own store and franchisee will be around 15 to 16%. To our understanding, it is number 2 or number 3 in the industry, and that was also reflected in our return on net worth last year, and which was consistently for 3 years in the range of 19.5%. It was number 2 to number 3 in the industry. So we are very proud that while we are keeping the pricing competitive, we are not falling into the trap of giving discounts on the gold metal, and we are still maintaining a good margin and good return on net worth. More so, with one India, one gold rate, which the industry is talking, that will definitely further lead to reduction of the competitive intensity and the penchant for giving discounts, and which will improve the bottom line for all the players.
On that note, we'll let you go. Thanks so much for making time and speaking with us today. But getting back.
If you like this video, then like, share and subscribe to ET Now.